Happy Halloween, everyone. It is Randy Bruns, also known as Captain America, for today only. This is our Q3 2024 Market Insights series, and we wanted to choose something that was especially on theme with today. And what scares most adults, or what can scare adults, is spooky volatility on your portfolio. But we know it's nothing to be scared of. So we're going to move me over here and let's just get into the data here. So we pull from Vanguard's most recent capital market model forecast. One thing Vanguard does, it's publicly available. You can just Google Vanguard capital market model forecasts. They provide projected returns over the next 10 years and the next 30 years for all various asset classes. These projections are 30 years as of June 30th, and they're just for all of the various asset classes that we believe comprise diversified allocations, from large and small U.S. stocks in the U.S., foreign developed market stocks, emerging market stocks, real estate stocks, bonds, and cash. And because the big headwind that we all face as investors is inflation, we also provide Vanguard's 30-year outlook for inflation. Vanguard provides a range, a low to a high range for average annual returns, and then they also provide projected standard deviations. And if you don't know what standard deviation is, just know that that is the most popular measurement of volatility. So and the best way I can explain it, I apologize for anybody who's heard me use this example in the past. You might be a 150 average bowler. I'm probably a 150 average bowler, but I do not bowl 150s every single game. I think my typical range, my cluster of scores is anywhere from 120s and 130s and 140s to 150s, 160s, and the occasional 170. And then I do have outliers that get below 120s. I did have an outlier where I bowled a 199 a few years back at my niece's birthday party. But that standard deviation is the measurement of volatility around an average. So even though most 150 average bowlers bowl somewhere around a 150, that could also be zeros and 300s. So knowing how volatile your actual scores are or returns are above and below your average is very important in investment planning, and it's especially critical if you're in retirement. So let's now take a glance at the next page. So we took the range of Vanguard's high and low, and we just took the average of that range. So you can see the average returns of all these asset classes, and then the standard deviation. The higher the standard deviation, the more volatile, the more bouncy the asset class is, and the lower number, the more consistent it is. An example here, emerging market stocks are very volatile. They have a standard deviation of 27.1. Cash, just leaving your money on the sidelines, not volatile at all. Vanguard has a very low number of 1.9. And then you see everything in between there. If we go apply Vanguard's forecast to textbook allocations of stocks and bonds and cash, you can see 100% cash, 100% bonds, 100% stocks down here, and then various combinations of stocks and bonds in 10% increments. Here are the average annual returns blended, which were extracted from Vanguard asset classes that comprise these, and then the standard deviations, which also pulled from the internal asset classes. And then you can see consumer price index, inflation. We can look and say, well, what if we had $100,000 to invest over the next 30 years, invested today, and Vanguard's projections are 30 years out? We can see that based on these average annual returns, $100,000 in cash would grow to $288,930. In the bond market, where you are a lender or a bank, it would grow to $420,015. If you invested in the world stock market, it would grow to $713,637. And any combination of stocks and bonds is going to be a little bit larger growth as you add stocks to an otherwise all bond portfolio. All of these returns, though, all of this growth is bigger than leaving your money on the or not leaving your money on the sidelines, than the cost of whatever it is we're saving for, and that's inflation. So $100,000 of goods and services over the next 30 years, Vanguard believes it will cost somewhere around $186,540 in 30 years from now. So let's talk specifically about the popular 60% stock, 40% bond allocation. That we believe, with Vanguard's assistance, will average 6.02% over the next 30 years, and that would turn $100,000 into $577,609. But again, this is not a constant 6.02 year in, year out, every single year. That'd be very easy, but it's not. That's not the case at all. If you look back at standard deviation, and this is just a reminder here, the ride will be spooky. So it's not 6.02% every single year. There is a standard deviation of 11.38% that is above and below that, and we're going to talk about what that means here for the rest of this meeting, or the rest of this video. Average annual returns do not equal constant returns, just like the bowling analogy. My 150 average is not a constant 150 every single game. The empirical rule of statistics suggests that 68% of all returns will fall within one standard deviation of the long-term average. So if the average for a 60-40 portfolio is 6.02%, one standard deviation is 11.38 above and 11.38 below. 95% of all returns will fall within two standard deviations of the long-term average. So you take that 11.38 standard deviation, you multiply times 2, that gives you 22.76. You'd add that to the 6.02% average. That's the high end of 95% of experiences. But then you'd also take 6.02 and subtract 22.76%. That will give you 95% of returns. 99.7% of returns, which is virtually all returns, will fall within three standard deviations of your long-term average. 11.38 standard deviation times 3 equals 34.14, which would then get added to the 6.02% projected average and subtracted from the 6.02% average. These numbers, you'll see in a second what they mean. So the 68% of all returns falling within one standard deviation, down here is the 6.02% average. This to the right is positive, to the left is negative, and this bell curve is sort of a cluster of what returns will be over a 30-year time period. If you add 11.38 to 6.02, 17.4 positive, subtract 11.38, negative 5.36. 68% of returns, according to the empirical rule, if you have a 6.02% average and 11.38% standard deviation, 68% of your returns will fall somewhere between negative 5 and positive 17. If we go to 95% of all returns, now we're within the two standard deviations. Again, 6.02% average, 11.38 standard deviation. We would add 11.38 and add 11.38. That gets us to almost 29. But then if we subtract 11.38 and subtract 11.38 again, that gets us to almost negative 17. This is 95% of all returns. Will fall between negative 17 and up 29. If we go to the 99.7% of returns that fall within three standard deviations from your long-term average, that's 6.02. We're adding standard deviation 3 times, subtracting it 3 times. Virtually all of your returns, according to Vanguard, over the next 30 years, for a 60-40 portfolio that averages 6.02%, they're not going to be anywhere near 6.02% any given year. They will fall somewhere between negative 28 and positive 40. And that's something you have to be prepared for, because the market is rarely consistent around its average. It is very bumpy. So if you know that going into an investment portfolio, you might be down 28% in a given year, if you know that ahead of time, you're going to be much more emotionally prepared for it. Also, on the other side, if you know you can be up 40%, for example, you'll manage your expectations better and not get too excited, because all of these returns really just factor into a long-term average. What happens to the other 0.3%, because this is 99.7, where's the other 0.3? Well, 0.15 are higher and then 0.15 are lower. These are extreme events that don't really they don't factor in too much into investment planning, other than know possible returns can be outside of this 99.7% range. If we project returns by asset allocation strategies, so we know that we have these average annual returns for bonds, stock, 10% stock, 20% stock, all the way up to 100% stock. The averages get higher, but then you look at this is 99.7% of returns. It's possible for the bond market, even though if Vanguard says it'll average 4.9 over the next 30 years, it could be down 13.1% in a given year. Has that happened recently? Yes, 2022, the bond market fell by over 13%, which was its greatest loss on record. The bond market could be up 23%. Let's go to the stock market down here. A 6.77% average annual return over the next 30 years projected for U.S. and foreign stocks, the world stock market as a whole, but the range of actual experiences could be as high as almost 60% and as low as down 46%. That is an extremely bumpy ride that you have to be prepared for. Let's now focus though on focus on those actual highs and lows, which I just talked about. So again, negative or up 22, down 13 for bonds, all the way up to up 59 and down 46 for stocks, and then everything in between. If we focus though on the popular 60% stock, 40% bond allocation with the 6.02% average, but we know it could be up 40 and down 28. We'll look at a specific experience, and this is the very start of the Great Recession. Also, many people know it as the credit crisis of 2008, 2009. Some people might call it the housing collapse. But on January 1st, 2008, if you had invested $100,000 in a 60-40 allocation, or just put it in 3-month U.S. Treasuries as a cash alternative, or just measured it relative to inflation, here's what happened. So you had $100,000 to start, and this is January 1st of 2008. 14 months later, February 28th, 2009, your cash would have grown from $100,000 to $102,105. That actually beat the rising cost of goods and services as measured by inflation, where $100,000 of goods and services now cost $101,027 to 14 months later. But that 60-40 portfolio, $100,000, it fell to $66,135. And now that is spooky. That is a 33.87% loss. Not something you should be afraid of, though, if it is your long-term money. And if it's not your long-term money, you shouldn't have had it invested in stocks and bonds. It should have been sitting in cash or short-term CDs or government-guaranteed treasuries, etc. But if you said, okay, well, that was an investment I made back in January of 2008, what's it worth today? Well, we don't have today, but we do have the end of August, which is a 16-year, 8-month period. Watch how the numbers change. So that $100,000 initial investment back in January of 2008, it grew to $119,826 in cash. It was $102,000 14 months later by February 28th, 2009, but it only grew to $119,826. The cost of everything you're saving for or spending money on, $100,000 of that now cost $149,877 through August 31st of 2024. So cash actually proved a pretty crummy investment relative to whatever it is you were spending money on or saving money for. But that volatile investment that lost 34% of its value, and you can see it right here at the bottom, if you just zoomed out, it grew to $258,363 over the last 16 years and 8 months ending August 31st, 2024. And that is something to celebrate. It was not an easy ride. We had a great recession, a housing collapse. We had a global pandemic at the beginning of 2020, which crashed the stock market by 20 or 30% in a matter of weeks. We had the return of the highest inflation since the early 80s that caused the bond market to lose its greatest percentage amount on record. That took the stock market around the world down by close to 20% with it. And then there's all sorts of political drama. I don't know if you guys know or pay attention to this, but there's been a lot of political drama. We had an attack on the U.S. Capitol. But the resiliency of a diversified allocation, if just given enough time, turned $100,000 into $258,000. And that's it's just under a 6% average annual return. And that's basically why you should not be worried about investing. If you have any questions, you can find us on the web at www.modelwealth.com. You can also email us at letschat@modelwealth.com, or just go online, find our phone numbers, and give us a call. Hopefully this made some sense, and have a wonderful Halloween. Thanks, everybody.